Krishna Kumar Karwa, Managing Director at Emkay Global Financial Services. He's joining us right now on the show. Thanks very much, Mr. Karwa, for taking out the time. I'll start off first with what's been happening in terms of the flows, and specific to the mutual fund space. We got numbers to the tune of about 2.1 lakh crore of net outflows this time around in the month of September. You know, what's your sense around what's been happening to the market structure?
Good morning. And so typically I believe that as far as the September end is concerned, there are normally outflows as far as the debt mutual funds are concerned. And maybe this time around there was this scare because of the whole ILFS fiasco, etc. So there was some fear in the minds of investors, and maybe the outflows have got accentuated. But more than that, I think also important is that as far as even the equity inflows are concerned, on a month-on-month basis, we are seeing that the flows are, on a month-on-month basis, they seem to be reducing every month, every next month. So far it has been positive, no doubt about it, but looking at the way the structure of the market is, that it's relatively weak, and if you look at it, 40% of the equity AUMs is the one which has come in the last 2 years, and investors are possibly looking at zero returns. So that the fear is that maybe there could be some redemptions from this SIP flows, etc., which have been very robust so far. That is the biggest fear in the system today, is that the domestic investors who have been faithfully investing into the markets, will they continue to remain as faithful, or the fear of negative returns, etc., will these flows stop? I think that's the most important domestic reason to look at. I think globally, as far as the high oil prices are concerned, or the trade wars, etc., those are global macros. I don't think so we have any control over that. But the biggest structural issue which I see in the system is the reducing liquidity, and typically the domestic inflows into equity funds, they need to be robust to be able to manage or rather to be able to face the kind of outflows which we are seeing from the FIIs. Right.
So, Mr. Karwa, I'll just, stretch that point a bit. So far, local participation has been considered to be that Teflon coating for the market. Do you see that getting challenged because of all the reasons that you just highlighted in your previous answer, be it liquidity, be it higher crude oil prices, be it the rupee depreciation?
Well, definitely, I think investors are a worried lot in terms of the returns that they are seeing on their flows. I think, as you rightly said, that domestic liquidity, which was getting channelized either through direct investing or through the mutual fund routes or through the AIFs, PMSs, etc., into the markets, I think that is currently in a state of standstill, or rather it is coming off. And so far, touch wood, we have not seen negative or outflows from the domestic mutual funds. And that's the last citadel, according to me, in this correction that we are seeing. So far, the flows have been positive, and we have been able to face the onslaught from the FIIs. Now, in the next few months, if things don't improve, then that could be a challenging factor. But at the same time, I think the investor education which has gone about in the last few years, I think there have been very stellar ad campaigns by the AMFI Association, etc. So the penetration as far as into the tier 2, tier 3 cities, and the importance of SIPs and steady investing, and to look at long term, I think investors are understanding that. So my sense is that maybe we could see some reduction in flows, etc. But I think the education has been very good, and I would believe that investors would look at a slightly longer term perspective. And we have always seen that after every deep correction, there are periods of consolidation, but ultimately things turn out to be positive. The long-term growth story remains intact, and that message has gone out to investors, and I hope they will share the same faith.
Mr. Karwa, good morning. Neeraj here. What's the base case right now? We are seeing a semblance of buying or markets holding out in the last couple of days after the carnage witnessed over the last 1 month. Do you reckon that there is more in store because the earnings growth may not be as strong, or if crude continues to stay at the levels that it is, or the risk of that investors by and large may have in the run-up to the state election results that come out on December 11th? What's the base case currently?
See, the way I look at it is that I think from tomorrow, day after tomorrow, something in the next 15 days, we'll start the result season will be on. And I think it's going to be important to look at, more than the results, is the commentary from the various corporates in terms of how the various global macro headwinds, how they are getting impacted because of that, and what is their outlook post the rise in crude oil prices or the rise in interest rates, etc. That's going to be the important determining factor in the short run. As far as I think investors have also now got used to a reset in terms of the valuations. So we took the valuations of mid-market companies to one extreme, and in the last 5-6 months, I think there has been a lot of correction in the valuations. So probably now investors will get used to a lower valuations, and similarly, you will possibly see that because of rising liquidity in the last 3-4 years, we have seen a major uptick in the valuations of large caps. So probably investors will have got to used to a lower reset. As far as time frame is concerned, I think for the next 6 months, I think it should be broadly a time of consolidation for the markets. I don't think so investors are going to be in a hurry to buy stocks. I think it will be more of a, first they want to see stability in terms of the stock prices rather than seeing an uptick. So in risk appetite big time risk appetite will only come post general elections, not even after the state elections. I think that will be a trailer before the main show. So investors will be very careful in the next 6 months before committing more aggressive money.
Okay. What's the degree of strain in the NBFC space? Do you think all of that has been priced in? Because we're seeing companies getting beaten down out of shape, 40-50% corrections for companies which were the darlings or the toast of town a month ago.
Structurally, as far as the business models of various NBFCs are concerned, I think they are very robust business models, and they fulfill a need which is not filled in by various banks. So there is no wishing away the importance of the NBFCs in the whole credit ecosystem. Now, in the last 1 month, there has been a lot of scare in terms of liquidity, ALM mismatches, etc. And I believe that there are cycles, and there is this cycle where there is so much of scare in terms of liquidity. So NBFCs will tend to be very cautious for the next few months in terms of retaining their liquidity and possibly slowing down on their disbursements, etc. So there could be a slowdown in growth for a few quarters. But I believe that as the amount of carnage which has happened as far as the valuations of the NBFCs are concerned, or in terms of their stock prices, I think there we took things to an extreme, and many of the NBFCs valuations were at very high levels. And similarly, now what we are seeing is that things are going to the other extreme, where irrespective of the fundamentals, the valuations are being taken to the extreme or the other side. So somewhere, once it will take a few quarters, but over a period of time, many of the NBFCs, specifically the NBFCs which are corporate backed or which are into product lines where you don't see excessive competition from the banks, those NBFCs will do well over a period of time.
Mr. Karwa, what's causing the unrest, particularly for some of these auto names? We've factored in the Kerala floods. We're factoring in higher input costs. But is this cyclical to you, and do you see a turnaround for most of them?
See, I think in terms of valuations, again, versus historical, many of the auto names had started quoting at a decent premium to their historical valuations. So what we are seeing now is a reversion to the mean in terms of the valuations itself. Secondly, as far as even growth is concerned, I mean, there is the fear of the unknown in terms of how the rising oil prices, how that will impact the demand scenario, etc. And also if rising interest rates environment, whether there is an appetite or whether there will be a slowdown. So I think it's more a function of the fear in terms of slowdown in growth. Also, as you rightly said, that there has been a rise in raw material input prices, etc. So margins are going to be impacted. But domestic autos, I mean, at least for the four-wheelers are concerned, the passenger four-wheelers, I think that's an under-penetrated market. And over a longer term, I'm sure investors, if they invest, they should be able to make decent returns. Similarly, as far as the two-wheeler market is concerned, the penetration being what it is. And I mean, in terms of rising input costs or even because of one-time insurance, etc. But if you look at the EMI level, I don't think so there's such a big difference to impact demand. So I think currently there is more of fear of the unknown rather than actual. My sense is that investors should be looking to invest in the auto segment. Valuations are becoming reasonable. Currently, I believe that as far as the commercial vehicles are concerned, I think they are doing very well, and that's where the opportunity for short-term trading could possibly be there.
Got that. Mr. Karwa, we leave it at that. Thanks so very much for
Thank
joining
you.
us this morning and sharing your thoughts with us on the show.